Hi, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, here again with another installment of Charts of the Week for July 13th, 2020. Glad you joined us, and I hope you walk away with some useful information. Please see our disclaimer for important information. So our first several slides comes to us from our friends at First Trust, and they're pulling this data off of covidtracking.com. And as you can see in this first chart, it's kind of plotting the amount of positive tests next to the daily deaths. And so much of this has come back into the public conscience here is every time you turn on the news or look at Facebook, there's stories of more positive tests being evidenced across, especially the Sun Belt states, and it is a legitimately real problem. It's something that we should all be taking very, very seriously. But what First Trust has done is really wanted to emphasize both parts of this story. And so the bars represent daily reported deaths, and this is tracking all the way back, dating back to February. And as you can see, the initial really big surge in April, and then it calmed down towards the end of April as some of the states were opening up towards the beginning of May. And so both the number of deaths reported as well as the number of positive cases reported really tempered a little bit until we hit June. And so after Memorial Day weekend and then that 14-day lag, and you could see that the caseload really begin to pick up, and probably would rather draw your attention to the solid lines, and those are the 7-day moving averages. So it kind of smooths out some of the anomalies and in some of the daily reported data. And so obviously, what is very real is the increase in the 7-day moving average for positive tests for COVID-19. And obviously we're testing more. This chart does not reference the number of tests being administered, but it just it still is powerful in the sense that this is what's occupying a lot of the public conscience, and it's beginning to have an impact on some of the high frequency data, as we'll see at least one or two instances of here coming up. But importantly, before we leave this chart, is that amber or that brownish orangish line, if you will, which is in that continual decline. Now there's a lot been made of maybe some upticks in deaths in certain areas, but if you look nationwide, obviously there are hot spots. Texas, my home state, is certainly one of them, but up in the Northeast we've seen some of that death rate temper quite a bit. And so what you're seeing is a dichotomy or divergence between daily positives that are being reported and overall deaths that are being reported on a 7-day moving average. In the second chart, it's from First Trust off of covidtracking.com data, deaths as a share of hospitalizations here in the country. And again, this is from First Trust and some of their weekly tracking data that they put together and make available to registered investment advisors like us. So in the blue bars we've got reported daily deaths from COVID-19, and then gray bars that sit above that are basically hospitalization numbers that are kind of smoothed out, and then that line, that amber line, if you will, is a deaths as a share of hospitalizations. So again, as we've been treading into July, I think it's just important to keep track of this, that as somber and serious as this data is, we are seeing deaths as a share of hospitalizations can actually continue to trend down even as we have more overall hospitalizations. And some of that has to do with some of the treatments and remdesivir and things like that are being administered to patients that are exhibiting symptoms. So there's case history that was developed back in March and April that's now being put in, that has now been turned into best practices that is helping that somewhat. But again, to put that in perspective, not to belittle the fact that there are deaths, and this still remains a fairly tragic situation for a lot of people. But my goal here today is just to provide a little bit of perspective. And then this is something that still probably should remain fairly intuitive to most folks. Although I will say that from what I've been reading, there's fairly little data available on some of the really young cohorts, 1 to 4 and 5 to 14, that there's a very low incidence of, particularly even testing. Most of the testing is happening with the adult population, and as you would expect, the older you get, the more at risk you are, and the statistics clearly show that as you get older, the deaths on an age-related cohort basis goes up rather significantly. So as we kind of take a step back from the COVID data and just see, what's going on in real time, there's a couple of things that kind of jumped out to me this week. First is, when we had some of these openings in May, obviously we were flatlining on restaurants. Everybody was shut down. Restaurants certainly were shut down. On the left-hand side, we've got data from OpenTable, which there really weren't any. There was a 100% decline in table reservations, and then obviously when things began to open up, that trended up into June, and now we've seen a bit more noise in the data, and I'm not sure what to make of those little spikes there. I would probably tend to smooth that out, but what we're seeing heading into July is a clear tempering of that momentum, and obviously a lot of that has to do with fears and publicity that's being paid to, and attention that's being paid to the rise in caseloads that we saw in some of those previous charts. But there's a public sentiment that's kind of casting a pall over the progress of some of these high frequency data items, and this is just one of those. We've seen a little bit of tempering in the TSA checkpoint data, and if I looked a little bit harder, I probably could have found a chart there. On the right hand side, again, getting back probably a little bit more to the household sector, and just highlighting that there is stress in the economy that's not, some of this is not being written about very much. I mean, obviously on the commercial side, we saw a lot of forbearances, a lot of tenants that said, I can't pay my rent this month, and so we saw a lot of stress on the commercial side, which put a lot of stress on the real estate sector overall for investment purposes. But on this side, we're talking about households. And so this one basically says that there's 5 million almost households that have no confidence in being able to pay their home loans next month. And 10.5 million, so if you say 10.5 plus call it 5, that's 15 to 16 million households that have no confidence or slight confidence in their ability to pay. And then another 21 million households on top of that that have a moderate confidence. So, this is a fairly somber survey, if you will. If you look at mortgage-backed bonds and the integrity of those, you look at, lender balance sheets, and obviously you've got more lenders that are having to retain more of the issued paper on their own balance sheet. So you can see that this might indicate some stress on the margin. Both these charts, I think, indicate some stress on the margin as we've seen continued pressure being applied by the economy not being completely open. In this chart, we've got some data on unemployment, and on the left-hand side comes to us from the Wall Street Journal Daily Shot. You can clearly see, what we would widely acknowledge are historic lows in initial jobless claims, and this is weekly data that we get, and then we saw that number completely spike up in March when we had the forced closures of the economy for several weeks, and then they got better, right? And so we've seen a lot of improvement in this weekly data from a labor standpoint. In fact, much better than anybody probably would have expected. And so as we got into April and May, obviously the data continued to improve, and now we've seen it kind of level off at a level that relative to March and April is tremendous. But relative to where we were before the pandemic set in, it's clearly much, much higher. And on the right-hand side, it really kind of takes a little bit more of that near-term view, and it's very similar, data in the sense that you can see in that really dark blue section, kind of that downtrend, and then the leveling off and initial claims. But what you're seeing layered on top of that, and this is why I included this slide, I thought it was poignant to highlight the fact that pandemic claims. I mean, these are an additional claim related to the pandemic. These are PUAs, if they call them, as they call them, and so it's specific to the pandemic. And if you layer those on top, you can actually see that that number's kind of maybe slightly picked up a little bit. So I think clearly what this indicates is as we headed into July, we had perhaps a little bit less momentum on the labor front than I think maybe some of the headlines would indicate. And this is obviously something that we're going to have to monitor. So in this line, basically, again, more labor-related information here. So this just shows you essentially the labor participation rate, if you will, and the percentage of the population who are, actually employed. Again, we trended down and then we perked back up, right? As we opened up the economy, more people went back to work, so we had greater participation. And that number has kind of really leveled off, which in some respects really dovetails with the prior slide. And in this chart, coming to us from Mercer, it kind of, I think, embodies the spirit of, certainly what I feel, and I think is becoming very widely embraced by the consensus. And that's this notion that it's going to take several years for us to recoup our lost economic growth. And I don't think there's any doubt that we had economic destruction of 10 to 15%. That much is shown here in the April data, and this is monthly data. It's kind of almost like an aggregation of individual components of GDP, which is, in as much as possible measured on a monthly basis, even though the GDP numbers are released quarterly. But what you can see here is that we had a bit of a strong pickup in data as we opened the economy, but we have leveled off since then, obviously with a surge in cases. We don't know what's going to happen this fall if we get a second wave on top of the influenza season. But you can see, relative to where we were before COVID and that trend line, we're well below that, to the tune of at least, call it 5 to close to 10%. And I think that it's a very strong feeling. It's going to take us a while to get back. And this number, or this chart, really doesn't take into consideration any kind of a more draconian type re-shutdown, if you will, if that needs to happen. And obviously none of us hope it does. So this is, as we've done several times over these several weeks that we've been talking about this market kind of bounce back, if you will. I mean, our time history is very, very short for this. I mean, it feels like obviously an eternity to most of us that have been kind of having to deal with this for the last 4 months or so. But relative to prior drawdowns, and this chart highlights the tech bubble, the global financial crisis, and then that purple line, which is very brief and you almost have to train your eye to see it, is the COVID activity from this year. So we had a rather significant drawdown, but not to get anybody's dander up. But what happened in the tech bubble, obviously, it took a while to manifest, and so we were more than 2 years into that before we finally saw the bottom of the market. In the global financial crisis, it took about a year, from the peak to see the largest drawdown, and that was over 50%. Not sure we're going to get there, but I think we need to worry just a little bit about what happens if we get caught in a second forced shutdown, and that's where kind of that green line or the global financial crisis could come into play. So that's why it's very important, not to wax political here, but just very important for all of us to be careful, wear masks, be sensible, try to curb the spread so that we don't have to get into that forced shutdown. And I think if we're able to do that, then we can forestall some of the increased turbulence that we see here from these last two major market drawdowns. So a couple of charts here just highlighting kind of the difference between what's going on in the broad market versus what's going on with kind of a select few stocks. And I also have some one or two charts that come behind this that kind of emphasize this point. So on the left-hand side, excuse me, you have the NASDAQ 100 divided by the S&P 500 index. And that's the white line. The blue line is the NASDAQ 100 index divided by the S&P 500 equal weighted index. So if you assume, how to read that is the S&P 500 is an index of 500 companies. Not quite, but just for conversation purposes, just assume they're 500. The equal weight index is exactly that. It takes all 500, divides them equally, and weights them that way. Now, the index that you see reported on a daily basis is capitalization weighted. So if you assume that there's a company in there that has maybe a $1 billion market cap, and then on one hand, that's maybe one of the smaller companies, and then on the other hand, you've got Google and Alphabet, which recently tripped $1 trillion market cap. Well, the larger capitalization companies will have much, much more weight in that index. So the index that's reported is capitalization weighted. And what this chart is telling you is that the breadth of the market is narrowing in the sense that the large caps are really driving the boat. And the average market, or the average stock in the S&P 500 is actually down 14%, while the index overall is just slightly negative now. And so the left-hand chart really tells you that divergence has frankly been going on for quite a while. The right-hand chart is a little bit more of a near-term snapshot, and you can see that that both the cap-weighted and the equal-weighted were trending almost in lockstep, even through the downturn. But ever since we reached that trough on March 23rd, you've seen the FANG stocks. We're going to talk about those in just a second, but you can see technology really beginning to help separate the large caps from the rest of the world. And it's important because market breadth is narrowing. That means we don't have participation in the stock market from all of the companies in the index, and you really want to see that for a healthy market. So this is just a kind of another reference point. We've got another chart that follows this very briefly. The top 5 companies in the S&P 500 represent are up basically 32.7%. The S&P 500 index, as this is as of July 6th, so a few days old. The average for the S&P was down about 1.6%, and then the Russell 2000, which are small caps, for the most part, not all, but for the most part, about down 13-14%. So wide divergence from the top of the market, the largest companies, versus the rest of the market. And this to kind of put a bow on the conversation about how market breadth is really narrowing. This is a chart depicting the market cap share of the S&P 500 of basically the 6 largest stocks, and that's Facebook, Amazon, Apple, Netflix, Google, and Microsoft. And they essentially account for more than a quarter of the entire S&P 500. Those 6 out of 500. So we're talking about not even, barely even 1% of the index constituents account for a quarter of its market cap. So this is clearly something that that we need to be watching and monitoring as we go ahead, go forward. And finally, I want to end on this somewhat noisy and technical chart, but for all of the cares and concerns that we have over market breadth, there is actually one thing that I want to note that is somewhat positive, and these are moving averages. The red and the blue lines are moving averages, and so the black represents the pace of the market itself. Obviously, we had that big drawdown in March, and then we had the bounce back, and then it's been a little choppy. But if you look at the long-term trend, that's the blue line. That's the 200-day moving average price. So it kind of smooths out a lot of these bumps and bubbles, and you can see that we kind of trended up, and then we nosed down after the drawdown, and then we kind of picked back up. But what's important is looking at that red line, which is a 50-day moving average price for the index. And so this doesn't have as much smoothing because it's a shorter moving average time frame. So it picks up a little bit of the variation, and it's widely considered to be bullish when you have the 50-day moving average punch up through going up, punch up through that 200-day moving average. That's called a golden cross. So I thought I'd share this in the spirit of at least offsetting some of these, maybe cares and concerns with with a little piece of data that happens to be somewhat upbeat. So there you have it for this week. Hope you've enjoyed Charts of the Week. And feel free to reach out to me at any of the information there that you see on your screen. Would love to hear from you. Otherwise, be safe, wear your mask, and have a great week.